Started. All right, whoever comes in comes in. But I want to start with just two quick awesome stories. Uh, my brother never really gets excited. He called me one day and really excited. He's like, "You got to meet this guy." It was like 2017 or 18, and it was Darren. And he's like, "You have to meet him, this and that." So I got on a call with Darren. We hit it off right away. Gino told me, "I want you to get coached by him, this and that and the other thing." 2020, me and Darren closed an awesome 52 unit that Darren brought me and my brother Jake. And then this year, we closed a 37 unit RV. I mean, both deals are amazing. And it just stems to the Jake and Gino community and all that. Another story is Hendra. 2000, when was it, Hendra? I met you in Terrytown, 2018?
19.
2019. I was still at the restaurant. And I called Gino and I'm like, Gino, there's this guy Hendra who tagged me on Facebook. And from California. He joined your group. I didn't know who the hell he was. I wasn't in Jake and Gino. I was still full time in the restaurant. And I said, should I go network with him? Just to start practicing networking and meeting people. And my bro was like, yeah, go meet him in Terrytown. And I went down to Terrytown 9 in the morning, had coffee with Hendra, and I gave him 1 hour. And I did the Jake and Gino education for 2 years, 3 years, 4 years, from 2016. I knew the whole platform by like heart. I told Hendra, because he not to stress about the education, just do the education, network, get into the accountability groups. And Hendra, you remember that coffee we had? And then after that, me and you are in deals, dude. We just refied a 40 unit right now, 140% out. You know, and that's the power. Just taking action. And like I asked Gina, should I go network? I was like, why not? My wife thought I was crazy. She's like, why are you going to network this guy? You don't know him. You're not, But that's what we do. From me going to meet him for coffee. Now me and Hendra are in a 40 unit that we refied. We refied a 44 unit, and we're refining a 43 unit in September with Christina right now. And that all stems from Jake and Gino and MIH and everything. So that's a pretty cool story. And Gino, tonight I told you when we had lunch, we only have about 20 people. I formed something really cool. I made like an inner circle of like the best of Jake and Gino and MIH Mastermind, like really elite people,
Hmm.
people that are serious, and we're building really strong relationships to so that when people do deals, we're more careful. It's not just random people doing deals and really taking big risks. But in saying that, you told me what you wanna, did you don't have a presentation ready? We're just gonna discuss things, or
I don't have a presentation ready, but I figured we could share some of the things that we're working on. What's been really important for the last 6 months, what we're seeing in our market, what we are anticipating seeing, and just I guess a couple frameworks that we've been working on the last couple of years. I'd like to share that.
yeah. I mean, I know, and I gave him a little. I told him already what you're going to talk about. You're the maintenance guys, how you're implementing like the accountability and that. You're going to go over expenses, how they were maybe 5,000, and your expenses are lower because you guys are in bulk. Maybe they're at seven. Some you go over that, and then what was the other thing that you're going to talk about?
I wanted to talk a little bit about the profit first mindset, like with Mike McAllowitz when he talks about profit first and how I think real estate. I think people were investing in real estate just to flip over the last few years, and they forgot that it's a business. And now it's getting back to that framework where it's like, oh wow, I have to make money with my properties, and that's a good thing, I think. And I think if you start looking at it from that perspective and start underwriting deals with the metric we use the metric profit per unit, just to like have an idea and just have a different paradigm, a different way of looking at opportunities. I think that's something that I'd like to share as well.
Gino, say that once again because Jake kind of coined that phrase, PPU, profit per unit. Because on our draws, I see the PPU per door. So, how do you explain the profit per unit again?
So, I mean, how many of you here have read Profit First or heard of Mike McAllowitz? Show of hands. One, two, three. Ryan Byrne, you have not? Wow, you're a slacker, bro. You gotta, it's a great book because when we look at real estate, everyone's into accrual counting and they jump in the books and things look good, but you don't really know. And I was always in the cash world and I live in the real world. And whatever's in the bank is what you got, right? That's the reality. And when I started doing real estate, I didn't lose sight of that. I wanted to profit on my properties. And then I read the book by Mike McAllowitz, and I actually interviewed him about a year ago. And what he says, and what I like about it, is you have revenue here. What people do is they take their revenue, they subtract their expenses, and they get their profit, which is typically what you're supposed to do. But what he says is you've got revenue here. What do you want your profit to be? Let's say your revenue is $1 and you want your profit to be 30 cents. That means your expenses cannot exceed 70 cents because we're bought and sold this lie. And see, my brother says I don't get excited, but I get excited when I have to get excited. Yeah, we're bought this lie that you got to go big and you got to get to 1,000 units, you got to get to 5,000 units, or you got to scale. And I'm saying to myself, yeah, but are you guys making money? And no one actually answers that question. I learned by my mentor about 3 or 4 years ago. He said to me, revenue is vanity, profit margin is sanity, and cash is king. If you want me to repeat that again, I'll repeat it again. You should write that down and you should just like live by that. Because I heard a few years ago that cash is trash. I heard a few years ago that it doesn't matter how much equity you have, just continue to scale. And I think if you're really thinking about building a business long term, you hear people saying, I'm going to scale, I'm going to grow. There's a difference between scaling a company and growing a company. Growing a company is actually adding on expenses. You're growing a company, you've got to, hire people, you've got to bring on extra infrastructure, you got a sales team. That's growth, but you're also adding on expenses. Whereas if you're just scaling a company, you're working on systems, you're working on processes, there's not as much expenses going on. And that's a big difference that he talks about in the book as well. But when you're looking at this deal, how we think about it in our portfolio, we want to profit between $200 and $400 in profit per unit in a deal. So when we're looking at an opportunity, that's repositioned, right? When we're looking at a deal, we don't underwrite or look at a deal if we can't potentially profit that much per door. That's our portfolio right now. We're not syndicating deals. We're not trying to grow and just to do deals. So that's how we're looking at it. And I think if everyone looks at their deals, repositioned at a profitability, and every market is different. Some markets you can get $100 in profit. Some markets like San Francisco, you may get 1,000 because the per unit is a lot more. So it really depends upon what you want. But if you start looking at your business from that perspective, in my opinion, everything starts to change because then all of a sudden you start becoming an expense hawk. You don't start becoming sloppy and lazy and a little flabby because what happens is when you start thinking about just growing your revenue and growing your door count, you start like saying to yourself, well, I need a little bit bigger of an office. I need another staff person or I need this software. And you may, but at the same time, you're sacrificing profitability just for the sake of growing. Do you need to grow? And you've seen, I think, over the last 3 or 4 years, a lot of people have outgrown their infrastructure. They've gotten way over their skis. They've grown income, but their expenses have grown more than their income. And then you're saying to themselves, well, why am I in business? I mean, am I in business just to grow revenue or am I in business to grow profitability? And I just want to shine a light on that because I think it's really important. Does anybody have any questions? Anyone want to challenge me? Anyone think I'm crazy? Anyone think I'm...
No, I just want you to repeat what you said. The cash is king was the last one. That's all I got.
Oh, revenue is vanity, profit margin is sanity, and cash is king. And it's interesting because I heard that from a guy named, we were doing a scaling up coaching, and it was Vern Harnish who wrote the book Scaling Up, and we spent a ton of money on his coaching, and one of his coaches said that. I'm like, I love that because it's basically what my dad says. My dad used to say, it's not what you make, it's what you keep. That's the reality. If you want to become wealthy in this country, it's not how much you gross, it's how much you net and take home after tax. People are always focused on what they're making. It's not what you're making, it's actually what you're keeping and what you're able to reinvest. That's why multifamily has been phenomenal over the last 10 or 15 years for myself, because with cost segregation, I've literally wiped out my federal tax, obligations legally. It's tax avoidance, not tax evasion. Tax evasion is illegal. Tax avoidance is what we're trying to accomplish here. And if you can think about the tax code as it's written to stimulate behavior, that's why people who start businesses, that's why people who invest their capital and take risk have higher tax, I guess, avoidance. Tax avoidance. They're able to avoid taxes, or they're able to actually use the tax code. So I think people need to understand that, and I think it's important. So when you're doing this multifamily thing, you can have different assets doing different things. Like, I'm not saying every part of your business should be profitable. If you're flipping land or you're flipping rentals, or you're just buying multifamily and and flipping that to create equity. At some point, you want to stop and slow down and build part of your portfolio where you can have some type of cash flowing assets and you can hold them longer term. I'm not saying you need to hold every asset because we've transacted on a little over 2,500 units. We have 1,900. So we've sold about 600 or 700 of our units. They became functionally obsolescent. They got a little bit older, a little bit rougher of a neighborhood. We didn't see the potential for them. So we're just like, you know what? These units we want to leave. And then from those properties, we just roll our money into newer assets.
Gino, what one thing I want to say, don't lose your train of thought where you're going, is this is very important, is I tell everybody, um I will say this confidently, you and Jake are probably top, well, one, I would say. That's how confident on multifamily investors with cash flow. You don't syndicate. This is why. Syndication is a tough game where they're paying. I'll give you an example of a deal. You called me all excited. I didn't get into this deal, which I wish I did. It was later on, and I had too many deals going on with other people, with Hadar and everybody. The deal you bought for 9 million, and the seller came into. I own the deal on the same street, the Maryville deal, the 82 unit I own with you, right
Mm-hmm.
down the block. The guy came into the office. And I want them to understand the reason you're very successful is you'll do one or two deals a year, but it'll take you the whole year to find that deal. But you may drop 900K in the deal, and that's the only deal you do the year. That on the block in Maryville, the seller came in the office and said, "I want Jake and Gino to buy it to a property management company." Jake, he was on the phone with Jake, and Jake was like, "What do you need?" The guy said 9 million. Jake almost fell out of his seat. That deal appraised at 15 million. Like, how does that
Mm-hmm.
happen? How did that guy, like, I mean, you were there. Jake negotiated. How do you? I mean, that's a deal. That's going to cash flow day
Uh,
one. That's a
you know,
real fine year two.
It's one of those things where you just are in the business all the time and you're just talking to people. And sometimes the Lord just puts things into your lap and he says, "Hey, you know what? You've worked hard enough." I don't think there's anything as luck. I think we all make our own luck and you just got to work hard. But you were saying something about syndication. Now, syndication is a great tool. It's a great tool when the market is elevating and going up and you can give a rate of return of 8% to your investors. That it's great because you have less money into a deal. You may not have as much control, but it's a different strategy. And we did it and we were able to actually bridge the gap. We ran out of money. So if you're low on money, or if you want to take less risk in a deal, or if you want to be part of a deal, not have all the upside, it's an awesome strategy. It's just got to a point that we didn't need to use that tool anymore. And right now in this part of the market cycle, it's a little bit more difficult because of where interest rates are, right? And where if investors want to get an 8% return, and then interest rates are 6 or 7, you've got to get 14 or 15% on your money. It's very hard right now to do that. It's not impossible. I'm just saying it's a lot more challenging. So I would say you use that strategy when you have a deal that's great, but you can't afford to do it. It's like, okay, let me syndicate that deal. Awesome. I'd rather right now do smaller deals, 20 units, 15, 30 units myself with just a couple of people to be able to control that equity, right? That's what I would do. But syndication is a great tool. And I think it's going to come back in the next 24 months. I think in the next 12 months, it's going to be hard because LPs are sitting around talking about everyone losing money. They're all around the water cooler. They're all complaining. And that's okay. They didn't complain over the last 10 years when they were making money. They're just complaining now that they're losing money. And that's just the reality. So you're going to have to get through that. But if you do have a good deal and you have a good brand and you've been, talking to your investors and you're really connecting with them and making sure that, you're on their radar, when you do have an opportunity, I still think there's a really good chance of people being able to raise capital because I think people looking at the stock market are going, I don't know. I'm not really sure. I think if you have a good opportunity, I think syndication is a great tool to use.
Yeah, but what's really impressive is how the team built with Mike, Jake, and yourself, and how you guys could take down any deal like 200. That you've grown to that you did the three syndications, and Jake was like, "Syndication is not for me, man." And the impressive thing is to be able just not to do syndication, and the amount of cash flow that you could get out of it.
The only thing I would say with syndication, the other challenging part is I think sometimes people do syndications for fees and they start this business and they've got to like feed the business. And then the other problem is you have all these investors and they're like, when's the next deal? So you're sort of under pressure to do a deal to satisfy them as well. And I don't want to be under pressure to do a deal because I always say, this is my mantra. I've learned it. I did a bad deal in 2006 in New York. I owned the deal for 10 years. It was probably the worst 10 years of my life in business, like the worst, like ever. I lost probably 700 or 800 grand on that deal. I always say no deal is better than a bad deal. I always say that. I always preach that. And I always make fun of Jake. And I always tell people I have a life before Jake in real estate and life after Jake. Jake is the only person that I know in real estate that has never lost money in a deal. It's because I'm the one who lost all the money before I met him. So when I met him, like I already knew what not to do. He sort of learned on me. And Jake is really excellent at being an expense hawk, and he's excellent at looking at stuff and saying yes, no. And then when you couple that together, when you have two people looking at a deal with different ideas and mindsets, we're like, okay. And then the ability to look at, a lot of deals a year and then only do one or two, it's frustrating. But I've learned that you do a really bad deal, it can really affect the next 10 years of your life. I learned that. Fortunately for him, he never really experienced that, but I think he knew what I went through, and we were very diligent on our buy right criteria and what we wanted to accomplish. And we never really had that get there-itis. If we didn't do a deal for a year or two, we'd still be like anxious. But it's like, it's okay. It's okay if we don't do a deal. I don't want to lose money. I don't want to lose capital. Warren Buffett says it best. He says, rule number one, don't lose money. Rule number two, go back to rule number one. I mean, I wish I had learned that rule a lot sooner in my life, but that rule means a lot to me.
So Gino, now that you said about not doing deals, we talked about it, me and you the all day. 2023, I only did two deals. I only did two in 24. I did 7 deals in 25, and this year I really doing. I'm having a great year because of refis. I'm breaking a record with cash out refis, and you have a bunch of refis going on also. But you touted this year. You guys really didn't do a deal this year yet, right? Or no?
We have not closed on a deal this year. It's been absolutely impossible to have anything even come close
Mhm.
to underwriting. We're 20 to 25% off, and it's not even close. And the problem is, put it simply, when you're looking at a property that's built in 1970 at a 5 cap or a 5.5 cap, and interest rates are 6.5, you're at negative leverage to begin with. That's the reality. And then, unfortunately, expenses have really shot up in our market in the last 2 years or 3 years. Expenses have shot up. Rents have basically flatlined, and occupancy is at 92%.
Instead of
So when you look
95.
at a deal, and this is what everyone should be doing right now, you should all know what your occupancy is in your markets. Our physical is 92. Our economic heads and beds is 92. People paying is 90. So that's the reality. It's been like that for the last 6 months. We cannot break that. So when a broker comes to us and says, I'm underwriting this deal at 95% occupied, rents are going up 5% a year, we're like, we can't underwrite to that. And your expenses are $3,500 a door. That's ridiculous. We're not even close to that. We're at $5,500 in operating expenses per unit. That's without CapEx. We're like at $7,000 a door with CapEx. So when you underwrite these deals, so if you do the math, real quick math, this is how I do underwriting to make it really simple for myself. I look at a deal, I look at the income. If the income's $1,000 and I'm looking at my expenses at around $500, so that means I have $500 left to pay the mortgage on that deal. And the rates are at 6.5. There's not much going on. Now, if that $1,000 can get to 1,200 or 1,300 because I know it, then I can say, all right. But a lot of these deals aren't going there right now because a lot of the deals are older, and it's frustrating. And all I could say to you all is just keep talking to your brokers, keep reaching out to them. Don't beat them up because they know the deals suck. I've never heard a broker that ever came to me and said, this deal really sucks, you shouldn't buy it. They're all out there. They're salesmen. They're salespeople. They have to sell the deal. So just make contact with them, continue to talk to them, continue to underwrite the deals they send you, and just say to them, hey, I'm sorry, I can't get there on this one. Hit me up with the next one. And they know. They know. They will reach back out to you for sure.
Gino, it was November 2022. I came to you and we had breakfast, and I said to you, I said, dude, I feel like something weird happening, going into a recession, or just not like 2008, but and you told me, you're like, yeah, it's coming again, and I'm like, what? I'm like, what? You're like, history's gonna repeat itself. You're like, deals are gonna be on market because in 2022 everything was off market, whisper price, all this crap. Like, you know what I'm saying? It was so competitive in 21 or whatever, and
Mm-hmm.
you think it's gonna be like that forever, and you're like, no. You're going to see deals in 23, 24, and 25 on market sitting for 9 months. And I looked
Mm-hmm.
at you, I'm like, no way, dude. Everything's so hot. And you just keep saying what I keep saying to my group: history repeats itself. And what do we see in 23? Deals going on market, and then in 24, sitting 9 months. And then once again, guys, don't show this again. And once again, history's going to repeat itself where we're in this bad market, but history's going to repeat itself where we're going to get to a good market. I don't know if it's 28, 29, 30, but is that correct, Gino? Like, I mean, it's evolving. I don't think you'll see the cash flow like we did in 2013 or 15, but
It depends. Mark Twain says history doesn't repeat, it rhymes. I think that's more accurate because it doesn't really repeat. You don't get the same effects because interest rates are different. We have a black swan event going on. We have a war going on right now. We should have had a recession in 2020, but COVID hit, pushed that back for a couple of years. Then we had a ton of money flooding the market, and then those are the issues. But I think when you look at market cycles, depending on where you are in a market cycle, you just need to be aware of what city you're in. Like in our market in Tennessee, we have a lot of deliveries. All right. And the problem is they're not all getting absorbed, but we're fortunate that we're having population growth. So we know in the next 6 to 12 months, that's going to work itself out and there's not going to be that much building. And that's for the vast majority of what's going on in the US right now. That's why it's difficult right now. That's why occupancy is not moving. That's why you need to know the market. So when the broker tells you 95%, you can say, God, dude, it's not 95%. But as far as repeating itself, I think what I see is everyone says interest rates are going to go up. And if they do go up, that's going to be challenging for a lot of people because people are banking on them going down. I wish they would go down myself. I've got to refi a lot of stuff next year too. But as far as deal flow, we don't have the deal flow right now. So you can be doing other things right now. And I think that's what we could be talking about as well.
yeah, I mean, and guys, as he's saying that, do you realize one thing? Like, I talked to Jake, and even if you don't find deals this year, Jake's like, I am multifamily. He's like, I'm doing multifamily for the next 30 years. So that's why if you don't get a deal this year, it doesn't matter. You don't stop doing multifamily because you didn't get a deal this year. You just keep doing it until you get a deal. They're gonna come. I mean, like for example, Jake and my brother have the biggest blue footprint in the industry, and they're not doing a deal. So if you're struggling, it's everybody is this year.
I think the challenging thing though is it gets a little I don't want to say depressing, but you get a little like you're saying to yourself, am I doing something wrong? And everybody on this call, you're not doing anything wrong. That's just the reality of where we are. And it's almost like when we were back in 2010 and 2011, where there were a ton of deals out there, but nobody was doing deals because everyone was sort of afraid. And you're like, is this real? I think I think if you're not doing one right now, it's okay. That's where we are in the market. I just think, to be honest, is what James Clear talks about in his book Atomic Habits, to set up a process where you can have that accountability with somebody and you're still talking to brokers on at least a quarterly basis and you're still doing some property tours. I think that's something that you need to do. Would love to learn more about your wealth strategies in Barbaro 360. Christina, the reason why I started this whole wealth thing, I became a money coach. And a money coach sounds as if somebody who teaches people about money. But what I realized was that the behavioral component in money itself, the emotion around money. Because when I say the word money, what does everyone feel like? You can feel the tension. Sometimes you feel like a little uncomfortable. The last thing that we talk about in this country is money. People will talk about their sex life before they talk about money. That's the reality. So I'm like, why are some people in my community doing deals and why are some people not doing deals? I was like, remember there was a kid, Ethan, he's 21 years old in Jake and Gino. He's doing like 200 unit apartment complexes and he's raising millions of dollars. How is that kid doing deals? He can barely sign on the LLC. And then there's people who are older who aren't. And it dawned on me that it was our relationship with money. And it was so obvious once I realized it. And I started reading The Psychology of Money. And then I started taking courses at K-State on financial therapy. I was like, wow, I'm onto something here. And then I made my wife become a life coach and a money coach. And then we started having these conversations around money, which was really cool. Like I could actually say to her, why are we fighting? We're not fighting around money. Money is the symptom. It's not the root cause. And once you realize that in your life and all of these beliefs and these patterns and these behaviors that you have around money today, they came when you were like 8 or 9 or 10 years old, when you were young, and they're unconscious and they're living out today. I mean, I'll give you an example. When I was 5 years old, I went to the grocery store with my grandma. I went to the A&P. I walked with her and She's Italian. She couldn't speak English. I saw a bag of toy soldiers there. And I said, Grandma, can I buy these? And she said, sweetheart, tesoro, I don't have the money. And at 5 years old, I didn't understand what that meant. But I remember there was shame and there was fear and anxiety around that. And I remember going home. She said, when your mom comes home to pick you up, we'll come back and get these toy soldiers. I don't ever remember going back to the store and buying them, but I remember that memory. And that memory that's created is called a financial flashpoint. It's an emotion around that money memory. And I brought that to my adulthood because all I heard throughout my young adulthood was save, save, save. Gino, you got to save for a rainy day, never for a sunny day. Only for a rainy day. And for me, that caused a lot of fear, a lot of scarcity, a lot of anxiety. There was shame around money. And in one way, it was good because I was able to save. But in another way, it was really challenging for me. So when I started a multifamily, I thought you needed money to make money. I thought that money didn't grow on trees, right? I had so many limiting beliefs and blocks around money. And I was just fortunate that I was in enough pain that I needed to do something. Christina, does this make sense to you?
Yeah, totally. And
Share
had,
share a
limiting
story.
belief.
Share a story about you. Do you remember what's your first money memory that you had? Do you remember what your first memory around money was? Whether it was with your family, with your friends, grandma, do you remember that?
I mean, it was always being generic, cheapest of everything. Layaway, you name it, right? So it's always like can't afford it, can't afford it, can't afford it, and saving. But that's where we did save. We had chores. We could save for what we wanted, and it was okay with me. Like you work hard for what you get, right? And that's all. It's just work hard and you get it. And that's just the way it's been. And talking about money, that's the thing too. That's why we were around like-minded people and we paid to be part of these masterminds so we can have these conversations because we really didn't have them growing up, right?
So it's interesting what you did in one instance is you like, I saw that. I don't want to do that. I'm going to do this. And that's what a lot of people do. Have you ever met somebody who's built $100 million business, has sold it, and is like, well, that sucks. What do I have now? That person was building the business because he was like, I'm just making a generalization, but I know a lot of people like this. I don't like my dad. My dad was poor. I'm going to do the opposite of my dad. I'm going to show everybody in my family I'm going to crush it. Well, they go out and crush it, but they crush the wrong thing because they're just trying to do something, right? They're trying to make money. And they think the more money they make, the happier it's going to make them. And then they sell that business and then they get depressed. And they're like, well, what's next? I've got to do it again without stopping and thinking, well, what should I be doing? What do I really want to do? And that's what the cool thing about coaching with money is. It's like we have all these memories. And if you're saying to yourself, I got to buy things on generic and I got to buy things on layaway. And then you become an adult and you've got money in the bank and you're like, well, I don't know if I should spend money. Well, why not? Why aren't you? Oh, wow. Unconsciously, you're still running that pattern of behavior as an 8 or 9 year old, but you're an adult and you don't even know why you're doing it. And the cool thing about this for me was when I started having conversations with my kids and how I screwed them up. And it's like, wow. It's like, I just had to come to Jesus moment. One of my daughters came up to me and said, Dad, when I was about 6 years old, we were in Gymboree. So can you imagine? I'm in Gymboree with 4 kids. I've got packs of, clothes like this. I'm already struggling to begin with. This is like 2011. And she comes and brings a pair of pajamas and puts them on the counter. And I must have looked at her and I must have gone, phew. And she took that and she remembered that. And she told me this about 6 months ago. She said, the way that made me feel is as if it made me feel as if you didn't care about me. And I had no idea or no recollection of even doing that. And can you imagine what that means to a 6-year-old when now she's 20 years old? She's online and she's looking to buy something and she's like not buying it. Something's holding her back. And she connected that memory of like fear and me being, I wasn't shaming her, but I was sort of like, we don't really need that, but I'm still going to buy it anyway. I made her feel really bad. And that's what for me has come out of this whole journey for me with money is actually having these conversations with my kids and with my wife about money and really not wanting to argue about it, but seeing that it's not the real problem. It's just a symptom of what's going on. And the fact that, my wife grew up totally different than I did about money. She came from a single family household, right? She had, week to week, they were living. They're blue collar. They really didn't like rich people. So can you imagine when she marries a person who owns a business and she's leaving her tribe? And they're sort of like, well, rich people, they're not the greatest, right? And she has that fear and that guilt about her That's why these conversations are so important to have amongst ourselves as spouses, because we, like I said, we don't really fight about money. We're really fighting about what's going on beneath it. So when she wanted to go out and spend money on organic, $4 for an organic muffin? What, are you kidding me? I said, you nuts? I've got to save my kids. I have five, I got to put them through college. And then I realized, well, it's not about the money. It's about the fear that I have around money. And then starting to make decisions around money based upon our values. Like, what did we value? We valued organic, right? We valued being healthy. So I'm like, okay, that's how I need to start making decisions around money based upon my values, not just the emotions around it, but trying to create some kind of logic, some kind of path towards making those decisions with the spouse.
Gino, what we talked about yesterday before this call was something I want everybody to hear and understand is
Sure.
we did a lot of great things together, the right way. And I hate when the gurus say, bet on yourself, quit your fucking job. I want to tell them how we did it. And we did
Sure.
patience, man. 25 years, me and you together at the restaurant. We did patience. We never looked to quit. So at 30 years old, you grabbed me, and I was great at working with you, and I was great at making money, but at 30 years old, my financial education wasn't there because Papa couldn't teach us, college didn't teach us, and I learned from you. You were always, when I was younger, I was spending more, and you were able to save and invest more, like when we were really young. And at 30, you grabbed me and you said, Marco, you're going down to a financial guy, Anthony DeStefano, our financial guy, and you're getting whole life insurance. And I looked at you, I was in the kitchen, I'm like, dude, I don't need it right now. And you said to me, you're like, you're getting it, and if you don't, we're not partners anymore on anything. Like, he's like, you need to get this. And then I went down, I got the whole life on me. I got term also, and we started doing buy-sell agreements. We did a buy-sell agreement on the restaurant, which I did a call on about. And I was telling Jai Deep about it with the partners. That was amazing. It was like I don't know, $500 for a year, and if I passed away, the insurance paid you 600 grand for the half of the business or whatever, and my wife was gone and you had it all. I mean, paid my wife or whatever.
Mm-hmm.
The next step was where we did really well was we messed up where I told you in 2006 I sold my house and I started building another house, and you were building another house, and we didn't buy that building near the restaurant because we were both building houses and we're stupid. Because we wanted nice houses, and we could have waited. We should have bought that building. But then where we did good was in 2013, Jake moved and we bought the first multifamily deal. This is where we did good. 2013 to 19, I was making money at the restaurant and then at the winery where me and you got into, where we were second business. And I was double dipping with the multifamily from 2013 to 19, where the restaurant paid all my bills and the nice cash flow from the multifamily was extra and able me to really build any business or just be really comfortable. If another recession came 2020, I didn't care. 2007, 11, dude, I suffered. We suffered, man. We just had the restaurant. And you had the shop. We had the shopping center where we were hurting, and you used your equity line to carry that until we sold it.
So when you go back, Marco, you said something interesting, and I would agree with you. Logically, when we say we built the home, it was stupid. But once again, go back to your money blueprint. Your blueprint was immigrant parents who saw wealth in real estate, right? They didn't trust the banks. They wanted business and real estate. So we viewed wealth as owning a home and building a house. So that's how we made decisions. Right now, if I'm just trying to make people understand and become conscious of that. Unconsciously, we were drawn into that because that's how our patterns and that's how we were affected by our family. Whether it was good or bad, that's just the reality. Some people like the stock market. Their parents teach them about the stock market, and they go into that. Great. I'm just trying to have people understand. Just let it make it be conscious. It was just once it's a conscious decision, great, right? Because people might be saying to themselves, "Oh, should I make this decision? Why am I making it?" A lot of times it goes back to the past and it goes back to what you did back then. That's why it's important to go back there and see what happened and then bring it to the present. And then from the present, bring it into the future. Like, how do you set plan going to the future? But you said back when we were younger, I think I shared with you that document about building wealth, the financial wealth. And
I put it on the chat. I put it on the chat. So most of them saw it probably.
yeah, and I've been reflecting on this because for me, I'm trying to teach my kids on building wealth, and I don't want them just to learn about investing at all. I want to paint a picture for them, and I tried to create an analogy. Like when somebody builds a house, you get a contractor, you're building a house, you need a set of plans, right? When you get the set of plans, The first thing a contractor does when he builds a house is he builds the foundation. And the foundation is the first step. And you can't rush the foundation. And that's what happened over the last 5 or 6 years. You see people jumping into certain adventures, doing businesses, buying syndications, investing in real estate. Their financial foundation wasn't built. And then when the market churns or interest rates go up, their house crumbles. And that happened to me back in 2008 when I wasn't stable. When I bought those deals, my financial foundation was not strong and I lost it. And I want to blame the market, but it's not the market's fault. It was my fault because I didn't have the habits. I didn't have the education. I didn't have savings set aside. I didn't have all that stuff with the foundation. Once you have all that, then you can start putting up the framing, which is the second step. All of a sudden the house starts coming up. The second step is the framing. You have the 2x4s going up. And that framing is, well, now you got to learn about the profit first. You got to learn about cash flow. You could start putting some money into stocks. You could start looking into businesses, but not really investing in there and continuing to build your savings. And then from there, the third step of the house, you have the windows, the siding, and the roof. That is the insurance. That's the protection of the house. And all of a sudden you start thinking about insurance, life insurance, health insurance, all that kind of insurance as you're building the house. Now, from the third phase, you go to the fourth phase, which is the sexy phase, which is the heating, the air conditioning, the plumbing, the electrical. This is the phase where you start saying to yourself, now I've got my foundation set. I've got money set aside. I know how to read a cash flow statement. I got my moat around the assets that I have. Now I can start investing in businesses. I can start buying real estate. I can start doing some type of intellectual assets. I can start buying some royalties, paper assets. This fourth stage, what I did in '08 was I ran to the fourth stage of the house, started investing, and then when the market turned, all of a sudden the house crumbled. And then after the fourth stage, the fifth stage is the fixtures, the landscaping, it's the finishing touches, which is what I would call the estate planning, making sure your asset protection is fine, working on your legacy. If you can try to build a house like that and give yourself 5 or 6 years worth of runway, I guarantee you your house is going to be really stable, and then you will not complain if interest rates go up because you've built a strong foundation. And I know it seems like a lot, and I know it seems long, but I mean, if you think about it, COVID was 6 years ago. So if you'd done this 6 years ago, you'd have a pretty strong house right now. I mean, I would challenge everybody, if you've got a child or young adult, I would read this book. I've got it on my desk, The Richest Man in Babylon. If you even follow the laws in this book, putting 10% aside, and you come back to me in 3 or 4 years, your life will be completely different. Now, I know it's not sexy. I know it's not get rich quick, but building wealth is not getting rich quick. It's getting rich slow. And I think 3 or 4 or 5 years is not slow. I think it's quick, but some people may beg to differ. They may think it's slower, but I think give yourself a few years runway. Give yourself some grace. It takes time to learn some of this stuff.
For them to hear this, watch. At 30, I got whole life, right?
Mm-hmm.
And we had the 4 family, we had the restaurant building, we had a shopping center down the road with Papa, right? So at 30, now you're saying, give yourself 3, 4, 5 years. I'm at stage 5, the last stage. I just did my trust and everything, 20, 23, 24. That's stage 5. Everything is done, okay? This is patience. 30 years old, whole life, started investing in Tennessee with you in 2013. 2026, I'm at stage 5. From age 30 to 52, 20 years, I patiently worked my ass off the restaurant and did every single stage slowly. After we made the mistake.
Marco, it's not to say that you don't go to stage 5 when you're in stage 1. You can still learn about it. You can still learn. You should still be learning about businesses. You should be learning about asset protection. You should be learning about tax strategies. But that's not where the focus is when you first start out. Like that should not be the focus. Should be really learning the business itself, whatever business you're investing in, whether it's land or self-storage or whether you want to buy a business. That's what stage 1 is. Don't focus on tax strategies or asset protection because you don't need to know that yet. And I think if you can focus on that early on, it will make it go a lot quicker. I just wish someone had told me.
Zip is in a good stage right now. He's got to look at that diagram because he bought a mechanic business and he's cash flowing like crazy, dude. So he's got to really look at where he needs to focus his things on, Sip. You know what I'm saying? Because I see you now you're able to, you have cash flow. Now you're able to invest in multifamily. So now you look at Gino's graph, Sip, you're in a good spot. That'll help you organize yourself on really what direction you want to go in.
And it's interesting because whatever business you're in, whether it's real estate or the mechanic shop or a coffee shop, it's all the same. It comes down to net operating income, and it comes down to producing, creating value in the business, and it comes down to employees. I mean, that's every business. It's very, now you may have some nuances. We may have some different things in real estate than you do in your shop, but that's really what it comes down to. So for me, I would continue to refine that business you have, continue to work on the processes, continue to see how profitable you can be. And AI is really good with this because you can ask AI a lot of assumptions like what should the profitability be? How can I make it more profitable? How can I create more systems within the business? How can I create customer experiences within the business? AI can help and coaches can help, but that's where your focus is right now. If your business is doing really well, save that cash flow, put it aside. And then as you get better and you can step out a little bit more from that business into something else, that's, you're on the path. That's the way to do it.
Jay, are you there? Jay's got a really good business, and he syndicates and he does his own deals also.
Excellent.
Jay, if you're there, if you have any questions for my brother, because I know you're looking maybe to sell your business, which is cash flowing very good. He did a spray net business, Gino, and he won like Rookie of the Year. He's booked out for like 3-6 months. He's doing great, but he may sell it. He had an 8-unit gut job as his like one of his first deals when he was 30 years old, and it had no roof. He went in, he did the whole gut job. The cash flow was like 4,500 a month. I think now like 3,500 a month. Refied out 300 grand, and half his deals are his own deals and half are syndications. Do you have any questions, Jay, about your business or about like the market or anything?
No question specifically, but this call has been like gospel. And it's almost like you know a lot of this stuff, but you should still listen to it every Sunday so that you don't forget about it. You sometimes tend to forget some of these principles, especially when you're running a syndication business. What Gino very accurately mentioned is it's quality over quantity. Who cares if you have 1,000 doors? Are you making money is the question. And a lot of times syndicators forget that. You just start buying deals and build that portfolio, and you buy some deals that don't make as much money. And I think that focus on quality is the key there. So I guess my main question would be for syndicators who are not like established syndicators with 5 8,000 units, who are still newer syndicators, what would be your advice to survive, so that, because I feel like if we survive today, we might be able to thrive 2 3 years from now when things return back to normalcy. So
If,
what's your advice there?
if you're a newer syndicator, I would find somebody who's been doing the business 15 or 20 years and try to partner up with them. That's just the reality. That's what I would do. And then maybe you can partner up with them and get some act fees. And don't be afraid to do a smaller deal. Don't be afraid to do a 6 unit or an 8 unit or a 10 unit, because I've had a lot of students who had partnerships in 100 unit syndications, and then they bought a 10 unit, and they were making more money in their 10 unit than their syndication. But it's a different kind of model because you need more equity for the 10 unit. You're a lot more active in the 10 unit. But if you're syndicating a 100 unit deal with 4 or 5 other people, there's not as much work for you to do. So you know what I'm saying? So there's just two different things. So for me for me to say a newer syndicator, how do they survive? Learn how to buy right, operate and exit. You got to learn the business, and you got to learn where you can add value to that syndication. Are you great at asset management? Are you great at property management possibly? Are you great at raising capital? Are you great at finding the deal? I would say you have to learn all of those when you're beginning, but then at a certain point, maybe you start focusing on, oh man, I really love talking to investors. I think I need to start a podcast and just get out there and just get the word and help build the investor base and really focus on investor relations. Or I'm a numbers person. I love Excel spreadsheets. I just love doing asset management. Let me focus on that. I think that's where people they should tend to gravitate to. But in the beginning, it is hard because you should really learn every aspect of the business, because you never know when you have a partnership. You don't know if your partners are doing the right thing. Like, it's like, are they doing the right thing? I don't really know because I'm new. But if you want to survive and, possibly buy deals, go out there and find other syndicators. There's big groups out there that are looking for capital. I forget Rob Beardsley's one of them. I know they're looking for people to help raise capital. I mean, there's people out there who need capital, but what I would say is just make sure you vet the sponsor. That's the key, is just always vetting the sponsor, making sure that they've hopefully been through a market cycle. Hopefully they've lost some money in real estate and seen what they've done once they've lost it. That's important. More important than always winning happens what happens when you lose the deal. So those are some things that I would do, Jay.
Gino, go. I want you to talk about which I thought was I love this shit when you get super granular. And Jake is crazy, man. Talk about what we're doing with the maintenance guys. I think Sip's doing something like this. He has a board like this. I was telling you that Sip is doing something like this. How you're doing it's accountability. It's a close rate. Explain. Not everybody can implement this. I know somebody who's very experienced. They can't even implement it right now because they got too much going on. You're implementing close rate on maintenance guys. Explain to them what you explained to me, what we're doing in the Jake and G in the Ram property management right now.
So this comes from what we call a BHAG, a big, hairy, audacious goal. And it comes from our quarterly priorities. Because like when you say people are doing too much, we're notorious for doing that. So several years ago, we decided to have quarterly meetings. Every 3 months, we get together, we select 7 or 8 priorities because we have a big enough team to do that. And every priority is about at least 8 hours of work. So fixing a website is a priority. Creating systems for a maintenance role is a priority. Tweaking something, an email, that's a task. It's not a priority. So the first thing to do is really when you're doing your quarterly meetings, and actually quarterly meetings, we just had one end of June, 3 weeks ago. We selected 8 or 9 priorities. So then you don't do more. And the way you select them is what's the bottleneck or what's the challenge? And then how does it relate to your big, hairy, audacious goal? So we are always saying we want to be the Chick-fil-A of apartments. We want to have really great customer service. So how do you do that? Well, you do that by having good property management, but more importantly, you do that by having good maintenance. And what we saw was about 6 months ago, our work orders, we had a lot of open work orders. And it sucks because you don't lose residents in real estate because the rent goes up. The majority of the time when you lose a resident is when you don't take care of their property maintenance. They don't say anything, they just don't renew. So we saw that, wow, some of them were like 75%, work orders were open. I'm like, dude, that sucks. So what you do is you get your total units, let's say you have 100 units, and you have 10 open. So 10 of the units, 10 open work orders out of the 100 means you have a 90% work order open rate. That's 90%, not bad. We wanted it to be 95%. So out of those 100 units, we only want to have 5 open at any given time. And we track it weekly. And at the end of the month, the maintenance team gets bonused on that. And what's really cool about that is what you measure, you can manage. If you don't measure it, you can't manage it. So we saw that as like our North Star. We're like, we want to get these work orders. And it's not hard to do. Once you start figuring out what you want to track, you just start tracking it. I'm like, wow, okay, that was great. Take it another step, which I figured out a couple months ago. I was on a call with some lady who is just she's a genius, really smart woman. And she was talking about close rate. She goes, Gino, what's your close rate? And I feel like such a moron. I'm like, what are you talking about? She goes, well, when a maintenance guy goes on your property, does he close it right away or does he have to go back? I'm like, I don't know. I got to get back to you. So I had Jennifer run the numbers a couple weeks ago on our weekly huddle, and it's called first time close rate. And it would be very good if you had a maintenance guy go out and diagnose the problem and close it on the first time. And we saw out of, let's say, 10 maintenance guys, some of them were 100%. There was 1 or 2 guys that were in the 60s. And Jennifer's like, well, that guy sucks his maintenance. No wonder. He's just he's going back. So it's a function of trying to see who's great in your maintenance staff, but it's also a function that you want to have a first time high close rate because you want the maintenance guy to go out there, fix the job on the first time and not go back out. So he doesn't waste your time and he doesn't bother the tenant and he closes the order right away. So if you can focus on work orders being closed and work orders being closed the first time, all of a sudden there's a trickle-down effect. There's an effect, a second and third order consequence that if you start focusing on that 3, 4, 5, 6 months down the road, you're going to have happier residents. You're going to have less residents leaving and you're going to have less turns. And eventually that's going to help the expenses. And, from there, we also talked about the retention rate. What we saw 2 or 3 years ago, nobody was retaining tenants because rents were going crazy. Why are you going to rehire, get a tenant back? Because rents are up 10%. So we weren't retaining as many residents. So we focused on the last 12 months of retaining tenants, and our retention of tenants that we want to keep. These are ones who have good credit scores, ones we want on the property is at 80% right now. And that's pretty good. Typically, you get 50% turnover, but of that 30% that's turning over, we don't mind if they leave. So that's another metric we're focusing on is the retention rate of residents we want. We have the close rate, first time close rate, and we have work orders. So if you guys are listening to this, what's your BHAG? What's the thing that you're trying to affect in your business right now? And then start thinking of a couple of areas that you can focus on. And then from there, start creating priorities that are going to solve that problem. Does that make sense?
Yeah. So, Sip, in your business, I saw that chart, the thing you put on the wall. You're doing something similar to mechanic business, accountability. You're doing like percentage of jobs being done and the speed, right? Explain what you're doing.
Yeah. Yeah, it's basically efficiency. So a guy will, there's in our software there's allowable hours for a job. So we track every guy's efficiency basically. If like he bills, 40 hours and he's doing 40 billed hours means he's 100%. So that'll vary a lot and it keeps everybody like on track as to what they're doing.
Mm-hmm.
So yeah, so it's similar to that, but
It creates
yeah.
like
And
fun
same thing.
competition. Like Mike's at 95% and John was at 88%. Like Mike's kicking his ass, and it's like, hey, dude,
Yeah.
right?
And we do bonuses based on that too, Marco. Like if a technician hits over 100% for 4 weeks out of the month, we'll give them an extra $200 in the next month's check
Awesome.
on the 15th. So it creates incentive for them to continue to be efficient.
Sip, I'm proud of you, man. Gino, he's got a really good bit. Gino, the
I
building.
appreciate it.
Gino, the building.
Listen,
He's in.
Marco, I'm here because
Beautiful.
of your brother. Yeah, like I mean, I joined Jake and Gina in 2018. I mean, I'm surrounded by people like Christina, Jay. I mean, you name it. Anybody on this call. I mean, Melissa, Alejandro. We've all become friends. Hendra, Mercy, everybody. Neil.
So do you
I
have
mean,
a
I
BHAG for your business? Like, have you thought about what your big, hairy, audacious goal is for your business?
uh, I don't call it that, but I mean, we have a revenue target for this year. So and it's 30% over last year. So that's
So
our goal.
revenue target is one thing, but I want you to have that unique selling proposition. I want you to wake up in the morning and go, man, that's what I want. I want to be able to I want to be able to affect this. I want to be able to have this really big goal, and it's not just tied to revenue. And that's what makes these companies stand out. And I know people are going to say, well, I'm only a small company. What does that have to do with anything? It is everything. It's all about your core values and it's all about your mission statement. And for me, I'm still looking at that with the Barbaro 360 with the family, because I'm really trying to figure out from my perspective. I'm really big into legacy, and I've been working on legacy. People say that legacy is something that you leave behind. To me, it's something that you activate today. And that's my mission, is trying to have people activate their legacy today, right? That's so important because we're like, oh, whatever I leave my kids, I'll leave it behind. No, that's not how I want people to think. I want people to think of their family life very similar to what their business life is. Their family life should have some type of governance, should have some type of rhythms, cadences of accountabilities, should have a mission statement and a core value. So I'm still working on what that BHAG looks like. But for me, I'm trying to bring it back to family and faith and relationship, but that's just too generic. So I'm still working on it for my business. So I want you to work on it for your business, because revenue goals are important. That's a really important metric. I'm not saying that. But if you have a BHAG, then everyone can work towards that vision that you're putting. The CEO sets the vision, the CFO gets the person to the vision, right? So if you're the CEO, you're going to set the vision of that BHAG, of Chick-fil-A service. That's what we want in our business. That's what the CEO is setting. Now the CFO is going to be out there, and the team is going to be out there saying, how do we get there? Oh, we get there with great property management. We get there with great maintenance teams. We get there with great, properties. We get there with great vendor relationships, all of that kind of stuff. We get there with great employees. That's how that BHAG works, because you're like focusing on that mission. And from there, you have all these priorities that will lead up to that. Because when you're saying revenue is increasing 30%, I'm thinking about it. Great. That's great. But like, once again, revenue is increasing 30%. What's the profitability? Like, I want you to focus on profitability as well, because
Oh,
revenue can go up 30%, but did you profit anything? And that's the last thing I'd say is with that profit per unit, we incentivize and we bonus our property managers on that PPU. If they hit a certain PPU, they get a bonus. I don't care about occupancy because you can fake occupancy. You can fake it for a couple months and then you're gone. I want to know, is that property, is that office profitable? And if it's profitable, they're going to worry about putting butts in seats, but they're also going to worry about delinquency, and they're going to worry about collecting rents, and they're going to worry about working with vendors and not overpaying on a flooring. See what I'm saying? When you incentivize, show me the incentive and I'll show you the result. Basically, that's what you need. So if your incentive is revenue 30%, but then you should also caveat that with what's the profit? What does my profit look like?
Yeah, you know what's
exactly. No,
crazy?
I've been doing profit one since day one. So yeah, glad you
All
mentioned
right.
that. Thank you.
You know what's crazy, guys? In 1995 to 2005, me and my brother worked on 30%, 33% profit at the restaurant. We were doing, say, like 17,000 a week and taking home a lot, like say eight and whatever. In 2018, most restaurants went down to 10% from 33%. It's crazy. It's just because a lot of cash was gone, just high expenses, high payroll, high
Yeah.
everything. It was very discouraging. But Sip, you are operating like me and my brother operated when we first opened Geno's. Your profit is doing well. Like I'm very
Thanks,
impressed.
Marco.
Very impressed. And Gino, the building he's in, the sellers who sold him the business and he's going to buy the building also. The building is pristine. Bro, I wish I could have brought you to see this. Me and you love looking at this stuff. Gino, I've never seen a mechanic shop so clean. And he bought a shed next door with the mechanic shop. He added two bays there. So he already like multi already added two things, and he has a towing company with it too. It's just such a great setup,
That's
man.
awesome.
I'm really proud of you, Sip. I mean, when me and Rob came out, I looked at him like this is more beautiful than the building me and my brother had at Like,
So when you go get it,
Appreciate it.
you're gonna get an owner occupied loan, owner occ loan, and I would go to a credit union. Credit unions right now are giving the best. They're giving the best rates and they're giving the best terms. So I would look at credit union. I mean, community banks are always really good in town because they're going to work with smaller guys, but you're owner occupied, so you could probably get some pretty good financing on that thing.
yeah.
Appreciate it.
So
Yeah, trust me, yeah. Well, Marco knows all about it, but we're
yeah,
working on it.
and it's really, I'm telling you, I know my brother would love. I mean, I saw when I saw the building, I'm like, holy shit, these guys really took care of this building, man. Like it's really beautiful. Yeah,
Anybody else have any other questions? Anything else?
Yes, Gino.
Yes.
I listened to some of your recent podcasts, which was interesting. Um, you guys were talking about potentially looking into commercial, maybe triple net, maybe some retail, industrial was doing well as well, in the recession
Yes.
and generally outperforming. Well, where are you at with this?
So once again, remember I said the big, hairy, audacious goal? If we go into
Yeah.
those businesses, it's going to pull us away from being really good at what we want to do. And we almost bought a shopping center. We're looking at a shopping center, 40,000 square foot retail, but we don't really know that much about it. I don't want to go back and learn and like completely, I'm already built for residential leases. I don't want to get a commercial agent to lease that. So I'm like, you know what? I never got into RV parks because it was sort of the same thing. They're great opportunities, but at the scale that we're at, I'm like, should we go learn something new? I know it's hard. Hadar is like, I want to do a deal. I could go do an RV park. I could possibly go do a mobile home park. But I'm like, they're different avenues. They're different models. And all of a sudden, I got to learn that property management. And it's going to take me away from the BHAG of trying to be really good here. So for us, it was just like, you know what? I don't think we should do it. I'm not saying that anyone else shouldn't do it, right? Like what Sip is doing, it's really cool. He's got the towing and they're sort of related, right? They're sort of related businesses. But if we're going to go into commercial where we have like long-term leases with it's just a completely different model than what we're doing in multifamily.
dude, I can't believe you just said that. Like I talked to Jake, he didn't mention that. That's new to me. But Hadar pays attention to your podcast, which I
Yeah. And so you stay in your lane, Gino. That's what you're saying. You're staying in your lane. You're not a motivated buyer. You're going to wait for the right opportunity.
Yeah, I mean, that's just what I've learned. Like when I started out before I met Jake, I had done a 4 unit, which did well. Then I went into a strip mall, which did really bad. Then I did a mixed use building, which did really bad. Then I went into a mobile home park, which did really bad. I'm like, what the hell is going on here? And I finally figured out I like multifamily because I'm getting monthly recurring revenue. Every month I get paid by a resident, and I can control it. It's still a basic human need. It's not going to change. I don't think anytime soon. You can't buy it on the internet. And we need a housing. And literally, renting a home is like 20% cheaper than buying a home. So it's still a bargain. From what you hear out there, it's still a bargain. And I think for me, long term, it's still a viable asset for me to own, and I know what I'm doing in it. So for me to jump out and do RV parks, they were the rage 5 years ago. Everyone was talking about an RV park, and I'm not saying they're not great, but I don't know, like $300,000 for an RV when people are struggling, and it just didn't appeal to me. I'm like, I don't know this space. It's just a little worrisome for me.
Gino, this is
Okay.
important for them. I talked about this with Jake, and maybe you can help out. We have the 40 unit where we're going to build 44 units, and I was asking Jake, like, should we build? Should we sell? What should we do? And he walked me through it. I'm not going to go into what he said to me. You guys have a piece of property you bought for $1 million, and you're selling it for a lot of money right now. But do you think does Jake want to build in the future? Do you guys want not now, but maybe in the future, or that's something you don't really want? You're just going to stick to multifamily, or is building new something Jake wants to do?
So
That's sorry, Gino. That's kind of another question I wanted to ask you, which I'm happy that Marco touched on it. The ground up construction. What do you think about it
Great
in
question.
general?
Full disclosure, I have the most admiration for builders. Like, they have the hardest job in the world. They're literally taking a piece of dirt, having to fight with the city and the town and the neighborhood. Work on this thing for 3 years, pray that everything goes well, and at the end of 3 years, hopefully that their assumptions actually worked out, and then all of a sudden get called rich and greedy and all this. It's the hardest for me. It's the hardest area. Now, there's two different kinds of builders. There's a merchant builder who builds and then flips right after 3 years, and that they just do a lot of volume. Now, for us, what I would have done, we ended up buying two big pieces of land. We just got lucky with the prices. We bought them. If I was to build, I would start with 10 units. Once again, it's sort of in our lane, right? We don't know the building, but we would start small. We have a lot of teams that could do a lot of the work, but we'd still have to do the infrastructure. Infrastructure is expensive, so I'd have to learn. But I would learn with a small project if I was going to do it. And then if I liked it, I'm like, okay, I can refi this out, get a construction loan, hold it long term, get the cost seg, and then maybe find another one. It just takes a long time to do that, and it's a lot of risk. It's a lot of work, and it's gonna cost you more than what you thought on the first try. But I think if you do that, it's just another one of those where, okay, I'm doing that. If it works out, great. It's another tool in my tool belt. And at certain parts of the market cycle, great. Can you buy dirt for that price point? You need to buy it for it to make sense. I think dirt's a little bit more expensive now than it was 3 or 4 years ago, and interest rates are sort of hurting builders right now. For me, I would start really small with a small property. 40 units is probably the max that I would do. We have 267 lots that we can build on, and they want us to build in one shot. How the hell are we going to do that? Like, I can't even wrap my mind around that. Like, the infrastructure that's going to cost 30 million bucks, probably, maybe more. I've never done anything like that before. That would be suicide. Remember the financial foundation? Like, the house would crumble if I did that. Like, I know I would screw that up one way or the other. So I'd rather just, hey, you know what? We bought it. What we should have done is we should have segmented it off into 3 or 4 different parcels, but the engineer didn't tell us to do that. We didn't know. And we just put it all in one contiguous lot, and we're going to find somebody to buy it. But building is very challenging. Now, Hadar, to play devil's advocate, I could go find somebody who's in the business, and I could say to the person, let's build it together. And then once we build it, you're the contractor. You build it. Then after it's done, your job is over. We'll manage it and we'll split the equity. I would consider doing that, because then it's a win-win, because that person is going to build it. He's going to cut his costs. We're going to manage it for 2.9 or 3%. He's going to have the cost seg, right? After he owns it, he owns an asset. He doesn't have to manage it. We manage it. So that's something where I would consider doing.
So
Thank you.
Jake, on my property, I told him Aaron's got building connections, so does Andrew. And Jake advised, he's like, dude, to have a talk with them and partner with a builder, like you just said.
Yeah.
He's like, because I said to him, I'm really excited about this, but like you said, it's risky. and he's like, and I like we had Joe Mike. He's like we do have building connections, but it makes sense if we partner with a builder, we de-risk it a little bit, like and he will
Yes.
cut his costs, and you make less to make more. You
But
know,
just remember what you need to do. Honestly, I've made this mistake before. You need to set expectations from day one. You need to have an entire scope of work. You need to have what things cost. You need to make sure who's bringing in what money. You need to make sure you have the banking connections. You need to make sure once you exit the deal and it's closed and you start renting it out, that there is a property management agreement in place. You need to make sure that the equity splits are already there. Everything has to be laid out from day one to make sure that there's no confusion and nobody says, "Well, I don't remember you saying that." That's the challenging part about like partnering with people, is because sometimes people hear what they think they hear, or they remember wrong, or whatever the case is, because that is a long process. 44 units is probably going to take you 24 months to build and then to lease up. It's not a slow process. It's going to take a couple of years.
we're gonna do in stages, I think. Well, like all at once, but yes, we're gonna do like they're 11 4 units. So
11 4
um,
units.
It's exactly like my 45 units, Gino. That
Yeah.
it wasn't for you. You remember in the
Yeah.
movers and shaker in
Yeah.
2019, you told me it's a no-brainer, it's a life-changing deal. But I was
Yeah.
shitting myself to go on it on my own.
is
And I
that is
did
that
it.
the one with the burnout unit, Hadar?
Yeah,
Yeah.
yeah, that's the
Yeah.
That
one.
is.
It's
That
the best
changed your
deal I
life,
ever
dude.
did.
That shit.
Changed
Yeah.
my
That's
life.
a Jake. I call it a Jake and Gino deal. When I tell people Hadar bought a Jake and Gino deal, that thing cash flows like fucking tremendous. You know,
And do you
Yes, that's
still do you
great.
still own that deal?
Yeah, yeah, I refinanced it twice, and now
dude.
I'm on Freddie Mac
Nice.
for
He
another
pulled
8
out
years.
Gino. He pulled out
Oh,
500K the first time. He put down 500K. And what'd you pull out the second time? Another 500K.
Another 400. So I pulled out my money back and then got another 500. So I'm 900 out.
that's awesome.
Um,
That is
yeah,
great.
Guys,
That's what I'm
yeah.
saying.
You know how I met Hadar 2019 at the Jake and Gino event? Hadar came up to me and was like, "Hey, I heard you want to do a mastermind." I went to Gino. I'm like, "Gino, this guy from New Zealand, how is he?" My brother's like, "He's fucking great. He came here from New Zealand."
Well, it's
Yeah.
one of those things where when you have enough, I don't want to say pain, but when you have enough wanting to change in life, and it's like people are like, "Well, should I start now?" It's a hard question. I mean, are you ready to start? That's the reality. The reality is most of us are on here because we're just fed up with what the results that we had, and we're adults, and we're like, this sucks what we're doing. Like, we know that we're built for better. And that's the thing. When there's a change process where there's stages that we have to go through. It's pre-contemplation, where you're not even contemplating it, but then there's contemplation. I'm like, should I do this multifamily thing? And then there's education, right? There's, wow, okay, I got to start really educating or being aware. And then it's like taking action. 80% of people in this world are not up to that action stage yet because they're just not ready. I think what happens is we need to have something that happens in our lives where we just wake up and go, this sucks. And then what happens is you turn around and you look around and you say, like, how is people like, I don't know, like Zuckerberg or Bezos, they're not that smart. They're not smarter than anybody else. They were just more motivated. They were just more apt to take action. And once you realize that real estate's not rocket science. I mean, I'm sure you've met a lot of the people in our community. I'm a pizza guy, basically. I wash dishes. I'm not that smart. I just figured out that I was put here, and if someone can do it, anybody can do it. And I had enough pain in my life that say, okay, now's the time to take change. So if you're out there, you're doubting yourself, I'm not really sure. It's more like you're just maybe not ready yet, and just look around and go, man, if that person can do it, what's holding me back? That's what happened in '08 when we had all these guys coming in construction, and they're all complaining about their jobs, and they're all not making. I'm like, we're not going to make money doing it at this place. I have to figure something out, and that's why I started. I started on my journey. It was from the pain. I was moving away from pain. So that's the great part.
2009, you came in the kitchen and you're like, I don't give a shit what we're going to do. We're going to figure this fucking out and we're out of here.
I mean, that's what
It
happens
took
in
us
life.
5 years. In 2013, we figured it out.
Yeah, I mean, that's what ends up happening. I mean, like, that's the thing. So if you're stuck or you're saying, I just go back and say, God put you here for something greater. He put you here for a purpose. And once you realize that, you try to figure out what your purpose is. Real estate's just a vehicle. It led me to create Jake and Gino. It's led me to create this Barbaro 360. It's led me to write books. So it's just a vehicle. And once I realized that, it's like, wow. And the true joy of life for me, it's not just making money. It's really going out there and just helping people. And I love that part of life. And if I had been stuck at the restaurant and I wasn't in that pain. So whenever we're always thinking about it, oh, why am I not happy all the time? We're not supposed to always be happy. That's not what life is all about. Life is really about contemplating the ups and the downs. There's hot and there's cold. There's happiness and there's sorrow. There's pain and there's pleasure. And once you realize that it's okay, but you figure out what you want to do, you get really clear on that, and then you just lean into that. Like Sip's creating that business. I know Sip is not creating the business because he loves to be a mechanic. Maybe he does, but I think what he loves is he loves the excitement. He loves the joy of building something. He loves the joy of growing something. And that's the vehicle that he chose. And great, he's figured that out. And that makes him really happy. That's what the goal, I think, for all of us is to figure out what we love to do. And then ultimately what you see as you start getting older is you just want to help people. That's what the ultimate goal is for everybody. If they get real clear and they get really good at something, it's like, all right, I've done really well for myself, but that's pretty good. But it's like, oh, okay. You have no idea. That's true. I don't either. Don't, yeah, I have no idea. But
Yeah,
it,
don't
it,
worry.
it is
Just
true.
know how to make money. Let the who not how. You're not supposed to be a mechanic.
But it's funny though, isn't it? Like if you think about it, like that's the joy. Your joy is like really building something. You have fun. Like some people like to fix things and like to tinker. Tony Robbins always said that. He always said that he was the kind of person that liked to take something that was broken and like to fix it. And that's what he does. He takes people now that I don't want to say they're broken, but there's something, not right with them or something wrong with them or something that needs a little guidance. And that's what lights him up. That's what he loves to do. And money ultimately, as I was saying, it's just a result. The better you are at something, the more money you're going to make. And that's really painful for a lot of us to hear, but that's just the reality. If you get really good at something and you really enjoy something and you can start marketing yourself a little bit better, more money's going to start coming into your life. That's just the natural cause.
All right, guys, we're like at 8:45.
Oh, I have a question. I want real quick.
Oh yeah, no,
Sure.
Going back to the very, very beginning.
Go ahead,
You
Melissa.
you were talking about, like what's your first, memory of money and stuff as
Oh,
a kid.
yeah.
Um, and I just want to know, like, I've also read before, I'm not really sure where, but at some point I've read where, like we're not supposed to actually make money a child's problem, right? But it's really easy for us as parents to be like, no, I don't have the money for that. Me and Alex are very guilty of that. Like, no, we spend a lot of money on our kids, but like sometimes you just have to say no. And obviously we have the money, but like sometimes that's just an excuse or whatever. So like, are we traumatizing our kids? Like, what do you like? What's your opinion? Because you said like one of your daughter's memories is like kind of traumatizing, right? So like, what's your opinion on like not really making money a thing that children should even know about,
Well,
right?
they should,
Would that be better?
no, they should.
Not know
Well,
about, but like
so let's put it this way.
money struggles? I don't know. We don't.
You're gonna screw your kid up no matter what. That's just the reality. Reality
Facts.
is we all screw our kids up, and it's always the parents' fault. That's the reality. What I'd like for people to do is to have an open and honest conversation with them. At certain ages, it's age appropriate. I know there's people that grow up where their families avoid money constantly. They don't even talk about it. So when they become an adult, they can't even open up their checkbook. They can't pay their bills because they've been quote unquote traumatized by that experience. So there sort of has to have a blend, and you sort of have to have a conversation about it. And every household has different ways about growing up. Because let's say you grew up in a household where your parents never bought you anything. Now you overcompensate by spoiling them. So there's just you have to find a medium on that, and then you have to speak to your spouse about it and say, and you have to be on the same page. And kids will model. They will. Whatever you're doing, you're modeling them. Like basically, however you act, you can say, "Hey, I'm not buying it for you," but then they open the closet and they see that you got 20 gifts in there for yourself, whatever. Kids see see through that BS. So for me, it's really having that conversation with my daughter, ask her what I did, and then really, I mean, my kids are older now, so three of the three oldest ones all have businesses. They're all invested in my deals. My son is on my weekly calls. So they're always around that conversation about money. And I've already started the conversation with the legacy piece. So we have quarterly meetings with the children as well. They know all about the trust documents. They know all about the money. They know all about the stuff that we have. What I would say is one of the biggest things that you can do that is a mistake, in my opinion, with relationships is that financial infidelity. If you're spending money and you're not telling your spouse, or you're investing in something and you're hiding it from your spouse, that's like the worst thing that you could possibly do. That's one of the biggest things that
Well, he does buy houses without asking, but it's
well,
okay.
but do
Good
you know though?
intention.
But do you know that he buys them though? I mean, like, is he hiding them and you don't know that at all? I mean, that's something. And sometimes we do that as men because, and for my case, I was doing that early on because I felt a lot of pressure that I didn't want to let my wife down. If I bought this deal and it crapped out, that's my insecurity. That's my fear. That's so I can have that conversation with her and say, "Hey, Jewel, I didn't tell you about this because this is how I was feeling. I didn't want to let you down. Like there's a lot of pressure." And so I really wasn't hiding it to be, but I was hiding it because I was sort of afraid. So it's one of those things where you want to have a conversation with your spouse. You want to lay everything on the table and just make sure that you have that open and honest conversation. I think in my opinion, it's like you're on the same team. You're trying to hit the same goals. Can you imagine if you're working together, how awesome that is? If the both of you can work together, and when you parent, you can disagree behind the scenes, but you have to put a front together and make sure that you're on the same page when you're going towards them. And it comes back to that values-based decision making. What are your values? Your values about responsibility. I'm not going to pay my kids for chores. You're going to make your bed, you're going to clean your room. No, but if they're going to wash my car or they're going to iron my clothes, that's something that I would pay. I'll pay them for that, right? Because we have a duty as a family. We're a family unit. They have certain responsibilities. We all have responsibilities. So, I mean, that's the way I sort of teach them about money. And one other thing I'll say about money is when kids used to get money from grandma, I would take it and I'd put it in the bank. We're saving it. And it's like, that's the worst thing you can do for a 6-year-old because it's like, well, what'd you do with my money? I put it in the bank. They have no concept of what a bank is. So start using cash. Create jars for them where they can see saving, spending, and charity. Those are the 3 jars that I would split their money up. Part of it you save, part of it you spend for yourself because you want to teach them autonomy. You want them to be able to see the money and you want them to be able to start making decisions with their own money. So when they become adults, they're not paralyzed. They can make decisions with money instead of saying, "Oh, I don't know what to do." A lot of adults that have this fear and this paralysis because they were never trained from it and their parents avoided it. So I don't want you guys on the call to do that. I want to teach your kids about autonomy and about how to use money in a healthy way.
Dude, we could go to midnight, man. This is one last thing I want to cover real quick. And Melissa and Alejandro, you might want to consider this if you're crushing it with the flips and your job. So Alejandro, say you have term life insurance. I hope you have something right now, term or whole life. My bro calls me up and he's like, "Dude, rip the Band-Aid off." He's like, "Did you get whole life on your kids?" And this is not for everybody, but this is a Rockefeller. It's not a get rich quick. It's a diversification, a wealth product. And I got whole life on my daughters last year. I should have got it 3 years ago, but he called me and was like, "Did you do it yet?" And I said, "No." And he's like, "You have the income. What are you doing? What's going on?" So I just got a year ago. When'd you do it, Gino? In 2020 or earlier?
I got all 6 kids' policies, I think in 21 I started.
Okay, and you want to do it earlier, but the same thing, we didn't rip the Band-Aid off because
It's one of those things where it's a very hard decision to make because it feels like pain.
Mhm.
You have to separate the idea that you're not investing money. You're not, this is where it's more of a storage tank. It's not correlated to any asset. You're putting the money aside. You're building a long-term, like once again, it's stage 5 money. It's not stage 2 money or stage 1 money. This is something you do as you built out and you're trying to create some type of protection. I look at it as an asset that's not correlated to the stock market. You're getting about 4%, income. You're able to borrow the money that you have in there to be able to use, right? And you're still earning interest uncompounded. My son fights with me. He's like, "Dad, it's not a good idea." I'm like, "Mike, you're 24 years old. It's actually a good idea for you, but it's painful because you're forced to save the money." And the other thing it does, which most people don't realize, it's a little bit more difficult to take out. So if you're the type of person who likes to spend money and is not as diligent, it's a lot harder to pull money out of a whole life policy than it is out of your savings account. And you're forcing yourself to save that money every year. There's no such thing as buy term and invest the difference. Nobody does that. 5% of the population does that. That's a fallacy. Although you should still buy term that's convertible to whole.
The good thing on the kids is the policies, you get a better policy because they're in better health, they're younger, it's more affordable.
Yes.
You'll get more coverage. That's the thing. When I did at 30 years old, I was top 1% health, which was good. If you get your home like
Yes.
at 40, 50, it's going to cost you more. So Rockefellers, when a baby's born, they get 5 million. They get a lot. You know what I'm saying? It's automatic. Every
Well,
baby born
they
at
do
Rockefeller.
that for one reason. They do that so the trust that they formed goes out and buys life insurance on Mark. So, and they actually, it's genius because all the cash in the trust goes out and buys the policy on Mark. Every year, the policy pays the premium. The trust has the ability to use the cash value in the premium in the policy if they want to, but they're going to leave it there. When Mark passes away, the trust gets the death benefit. So it continues to feed the trust. So it takes a little bit of time, but I mean, can you see how powerful that is? And
Yeah.
obviously, you need to have governance, you need to have family members on the same page, and you need to make sure that somebody is understanding with the trust. But that's the power in that. But if you do get it for your kids, the beauty of it is you start saving for them. And let's say in 5 or 6 years, you've got some money there. I'm still the beneficiary if something happens to them. But when Gabrielle turns 30 years old, I can say, here, Gabs, here's your policy. It's 1.5 million of death benefit. You got probably 100 grand in cash value. This is your gift. And you know what? If something ever happens to you, if you ever become uninsurable, you at least have this money here. So it's a way to save money, a way to put money aside, and a way for me, instead of putting it into a 529, because I don't know if my kids are going to go to college, I can access that money. And if they do go to college, here's the cash value in the whole life policy. So I think it's,
Tom Jocelyn's daughter, because Ralph Sessa got him the policies for his daughter. Anthony DeStefano, our financial guy. His 21-year-old daughter, 22-year-old daughter, has $1 million in fucking cash value, and she's investing in syndications with the cash value.
mm-hmm.
You know, and in multifamily and all
Yes.
other stuff. It's pretty powerful. So I mean, it's not for everybody, but when you start doing, I don't know, when you start doing well, it's something to look into. Correct?
Well, like I said, most people who have less than the 7-figure net worth think it's the biggest scam. Anyone between 7 and 8 figure net worth is like, I'm looking to it. Anyone above an 8 figure net worth, I've interviewed dozens of people. Every single one of them has whole life because, like, once again, I said it's like a stage 4 and a stage 5 kind of asset. It doesn't make sense. Like, why would I borrow money and pay interest on my own money? Well, I have that money there. It's not in a 401k. When I retire, it's provisional income. It doesn't go on my tax return. But money from my 401k, when I pull it out, I have $1 million, but I don't have $1 million because you got to take 30% of taxes and it goes on my tax return as well. So there's so many ways to avoid that's why it's a better strategy. But to Neil's question, 18 to 25-year-olds, what I would do is don't do what I did. Don't shove it down their throat. Don't make it like you got to read this and you got to read that. They're going to come to you. And it's interesting. They all came at different times. I started opening up checking accounts with them. I started opening up savings accounts with them. I started doing credit cards with them. I got into a website called the Khan Academy, KAHN Academy. It was a big group for homeschoolers that they have all these videos for financial education, and they've done a really good job. They do a really good job of it. I've created my own called Financial Independence on my YouTube channel at Barbaro 360. But I would start slow. And this is the book that I'd have them read. It's such an easy book for them to read. They can read it if they have any questions. And then I would also start showing them your stuff. I would start showing them bank statements, account statements. And then at that age, my 20-year-old and my 25-year-old, I've had them start their own S&P 500. They started trading, putting $200 a month in there. And like at the end of 6 months, Sophia's like, I got $1,800 in this thing already. I'm like, yeah, you see what happens. And then it's just small. You want small habits. You don't want to overwhelm them because what happens when you overwhelm somebody, they won't do anything. You just want to start small with them and just start having that conversation. And like I said, start showing them what your credit score is. Start showing them your checking account, your savings account, your pension plan that you have, and start talking to them about that. And as they get more curious, they'll come to you for more stuff. My son, at the age of 24, he just started an e-com site. I'm going to show you the package. If you guys can go online, he started this. He sourced this thing it's a crochet kit. And it's incredible. Like this is like 9 months ago. He was talking to somebody through China, and he went and got the manufacturing company. He had a coach, so he's paying a coach $60 an hour to learn this. I mean, it wasn't inexpensive for him, but he was able to source a product, learn what product worked really well. He started the LLC himself. He's got the trademark going himself. It's incredible. Like if they're there and they're watching you, they're mirroring you. Like when he asked me to start an LLC, I said, I've never done one, Mike, figure it out. And he figured it out. And this thing, I don't know how to do an e-com site. I have no idea, but like he figured it out and I just helped him. I guided him if he has any questions. I think that's what we should do for our kids. Like make sure that you don't overwhelm them with the money thing. And remember, once again, they're going to feed off of you. If you have fear and scarcity and there's shame there, they're going to feel that. So it's one of those things where it can be hard. It can be hard. I wanted my kids to learn about money when they were 5 and 6 years old. I was shoving it down their throat. My wife is like, "Would you cut it out? They're not going to read the shit." You know what I'm saying? It's like, but you got to read it. But like, it was just so. But now it's like, oh, great. Now they're coming to me and saying, "Hey, Dad, when's your next deal coming?" That's like, it's so amazing to hear that because I've sort of conditioned them to that. And it's incredible to see the older one and the younger one, the difference, the way they view money. It's just amazing what the transformation's been from my very first daughter to my youngest daughter.
Neil, does your kids see the nice deal that you bought with your nephew and how you're operating it? And have you ever brought them to it?
Yeah, yeah. Like AJ actually gave me his $500, so we did the Dave Ramsey envelopes.
Yes.
And one of those envelopes, he didn't understand it at the time, but one of those envelopes was investments. And I just told him, you take 10% of what you're earning, you throw this in this envelope. And he was just spurring that away. And when the deal was on the table, he said, Dad, can I get in on that? And I'm like, I don't know. Do you have any money? And he got like this deflated look because he forgot about his envelopes. And I said, what's in your envelopes? And he gave me $500. So he's in it for $500.
That's the best.
So,
that is the
bro,
best way.
So
You did it
he's
for
st-
1,000. You're
he's
gonna
still
add
like,
500 to it, and you're gonna call.
I give him like
you're gonna
$10,
call me
like
for
right.
1,000, dude.
I'm
Yeah.
sorry.
Guys, check this out right here. Gino's knife set from our restaurant. I used to sell probably $10,000. We sourced this from Alibaba. Our guy Adam, our friend. We paid $5 a box. We were selling them for $25 a box. Okay, right. I had them in the front in the restaurant. We jarred the marinara sauce. Me and my brother. We had what else do we have? We had a cookbook. I mean, we did some really cool stuff at the restaurant. If they
It's what
changed the laws in New York, we would have stayed. We would have did like we were starting to do what he said. We're building like but then we did good in multifamily. We're like, screw this, we're selling. You know, so this knife set was awesome.
Neil, did I answer your question? I just want to make sure that I answered your question.
Yes, absolutely. I'm
Okay.
touching upon all of that, and I guess that's the conversations you have even with children that aren't your own. Like when you're talking, like I have a lot of young, like 18 to 25 is primarily where my employees are. So just talking to them about those things
Mm-hmm.
is the financial foundation that they need because a lot of my employees don't come from this room right here, right? They just kind of like your regular W-2 kind of like Joe Schmo that I was. Like I didn't have a financial education until I sorted out myself. So just touching upon all of those points, and it was good to confirm that what I'm doing is everything that you said, like credit cards, checking accounts, bank accounts. Like they're so good now. My son opens up his own bank accounts.
It's the basics. You want them to learn the basics, and you want them to understand why they need a high credit score. You want them to understand every month you pay off the credit card. You start with the basics:
Yes.
need versus
Yep.
wants. You're like, what do you need versus what do you want? If that TV costs you $100 and you got to work 10 hours, it costs you $10 an hour. So you have to really rip it down, and you have to understand that they don't know anything. Like they're uneducated. So you can't assume anything. So you have to really make it simple. You have to talk to them in metaphors. Remember that whole sheet that I showed you? You really got to really rip it down for them, and don't assume that they know. Like you have to really make sure that you're explaining things to them clearly.
One of the best things you taught, and this is going back to like 2019, this is going back a long time, was it's not the dollar amount, it's how many hours did you have to work to be able to afford that.
Yes.
And
Yes.
then all of a sudden, it's not like, oh, it's only $10. Oh, no, wait a second. I had to work when they were like little kids, they got paid like $1 or $2 an hour. Like
Yes.
go do these things, right? Not chores, but if I'm going to pay somebody else to do it, I'll pay you to do it. And then you learn that work ethic. And how hard did you have to work? And is that sweat worth whatever it is that you want to purchase?
And
he
Neil,
learned.
the other thing I would do is I would make sure that when you give the kids a check, that you take out taxes. Because one of my daughters worked for Hobby Lobby, and she got her check, and she's like, "What's this?" I said, "It's taxes." She goes, "What do you mean?" I said, "Well, we have to pay the government." Well, she ain't going to be a commie or socialist because now she understands I don't want to pay all these taxes, right? So it's like, oh, okay. So you're starting to condition to them to saying, hey, you grossed 100, but you didn't take home 100. You really took home 92 because they took out 8% for social. So that's something that a kid wouldn't know that. But that's a conversation to have about taxes and about making sure that you have money set aside. My daughters have 1099 jobs. So I have them put X amount every quarter aside in cash to make sure that if they don't have their taxes at the end of the year, they have that money set aside to pay. So they understand how to budget and the whole profit first thing, making sure. But it's the same thing with a paycheck. Make sure that when you pay, one of these kids that they understand it because we're trying to grow capitalists. And if they understand, hey, I don't want to pay taxes. It's not fair that this money came out of my paycheck. It's like, oh, okay. So then you can start having that conversation. You can say nothing's free. There is no such thing as a free lunch. Somebody's paying. Oh, by the way, you got a job, you're paying. And oh, by the way, your W-2, you're paying more than Neil because Neil's got a business and Neil has write-offs. Oh, how do I be like Neil? That's how the conversation starts.
Yes. They actually have, like when we were doing envelopes, one of the envelopes was taxes.
That's great. That's exactly. Well, that's one of the profit first where he's got OpEx. He's got it's
taxes
true.
out of birthday money. Now, of course, I funneled that I funneled that back in.
Yes.
I funneled that back to them.
Yes.
And they never knew that, but they knew that we had that conversation, and they knew that came out.
Yes. Yeah, I agree. No, I agree 100%. That's awesome.
Gino, Neil is a great Jake and Gino success story of he joined. Took him 18 months, and he was doing mailers, handwriting the mailers, and in 18 months, he landed a deal, dude. That's like the Jake and Gino. You and Jake had our first 25 unit. It took, what, 18 months, 20?
Yeah, it's 18 months. I mean, like, that's how long depending on the market cycle. I mean, like, 12 months at least. I mean, to get your feet wet, to figure out the market, to learn some brokers, to make some conversations, to walk some properties. I mean, it should take 12 months, 12 to 18. If you do it quicker, man, you're a lot smarter than me, that's for sure, because it took us 18 months. But then after the first deal, it's like, wow, people know you. And a couple months later, you do another deal.
It's the same seller if you can.
Yeah.
Yeah. All right. Any last question? Or we're at 9:00 and everybody stayed on, which is pretty awesome.
I appreciate your time, Gino. Thank you.
Oh, you're welcome. I mean, if anybody's looking for money coaching, you want to reach out to me. My wife and I are coaching on money, and we're coaching on what else is she doing? She's doing some life coaching and relationship stuff. We're doing relationship coaching too. We love that. We love getting out with couples and just showing them how dysfunctional we are, and just making sure that they think that they're having issues. You should be in some of our conversations. You'd be like, oh wow, I got no problems compared to what these guys are doing. So if you want to get in touch with us, you're more than welcome to email me.
All right, guys.
Thank you.
You're welcome.
Yeah, thanks, Gino. Thanks, Marco.
Guys.
Gino, good to see you, Gino. Thanks,
Adara. Ciao.
Guys.
Gino.
Thank you.
Have a good night.
Thanks,
Bye,
everyone.
guys.
Good night, guys.
Bye.
Thank you.
Good night, guys.
Thanks, Gino. Thanks,
You're
Marco.
welcome.